Today, we'll have a look at Task F of the December 2023 APC, considering the pre-release information and the information on the day, followed by a competent response and a limited competent response. When looking at the pre-release information in document 6, you're provided with information regarding the tax return for 2022, which is due at the end of this month, December 2023, and that the senior accountant who usually does the tax return left before she could submit the income tax return, and that the junior accountant will step in terms of the calculation of the tax liability, and you need to assist with your tax knowledge as it's more up to date. When looking at the case study as a whole, you will see it's set in the aviation industry, and some information is provided regarding leases and maintenance, and therefore there's an expectation that you'd refresh yourself in terms of the tax treatment relating to leases and maintenance, and that we're also dealing with the December 2022 year end, and therefore the year of assessment as well. When looking at the financial statements, what one would need to consider over here is to go to the financial statements, looking at the statement of profit or loss and the statement of financial position, considering each category or line item as indicated in the callouts on the screen, what the tax treatment may be for those individual line items. And the same process would then be followed for the statement of financial position, what the tax treatment would be for those individual line items. When looking at the information on the day in document F, you're provided with a company income tax return in the first attachment, as well as selected financial information in the second attachment. And the task is requiring you to undertake a critical review, and that critical review is then defined as you need to consider each reconciling item, whether it's incorrect, partially correct, or needs further clarification. And where any of those are identified, you need to provide the correct tax treatment or state where the additional information is needed. And the second component to this task then would be to identify, if any, tax rate reconciliation items. If you move on to the first attachment, you will see that the tax calculation starts with a loss before taxation, dealing with each line item individually, whether there's an adjustment or not, and then providing the reason for that. And let's maybe consider one item, the unrealized loss on foreign exchange contract, which was the 1.5 million added back. And the reason for the add back is that it's unrealized and therefore not been incurred. However, we know this is incorrect. This add back is incorrect, as Section 24I3 states that your exchange losses, whether realized or unrealized, are deductible for income tax purposes. And if we consider something like the annual learnership allowance, where we may require further clarification, we see that an amount of 500,000 is deducted. However, we need some further information regarding this learnership agreement in terms of the number of learners, the NKF level, whether any of them are disabled or not, as this would help us to determine whether the amount of 500,000 that has been deducted is correct. When looking at the selected financial information, we see, for example, that further details provided on certain line items such as other revenue, employee cost, etc. And when considering our other revenue, we see that included in there is a profit on the sale of furniture and equipment, which is an accounting entry, and therefore from a tax perspective, would have to consider whether there has been a recoupment or not, or whether a capital gain or loss may arise on the disposal of the asset. And the same type of considerations would then have to be done for each note or line item that's provided in the selected financial information that has got an impact on a tax calculation for the 2022 year of assessment. And then if you move on to the task itself, and the required, it said, drafted email to Julio in which you provide him with your feedback regarding his income tax calculation. So that would be whether it's incorrect, partially correct, or further clarification is required, and then provide him the correct tax treatment or request further information. And the second component is to highlight any tax rate reconciliation items. You will now have a look at a competent response and a limited competent response.
In this part of the video, we now have a look at some examples of what a competent candidate's response looks like. And then in the final part of this video, we have a look at what a limited competent candidate's script would look like. So let's have a look at why this particular candidate was assessed as being competent in task F. The candidate begins the response with an introductory email. The candidate thanks Julio for assisting with the tax calculation in Tanya's absence. The candidate then notes that they have attached their review of the calculation with some guidance and comments, and then also notes that they've provided, as required by the task, the impact on the tax rate reconciliation of the various items listed in Julio's taxable income calculation. Let's now go and have a look at the individual items in the attachment. The candidate then presents the attachment, noted as the review of the draft 2022 tax calculation. It's presented in a tabular format with the item from the taxable income calculation. The candidate then notes whether they agree, disagree, or require further clarification, then notes whether the treatment is incorrect, partially correct, or requires further clarification, and what then the impact would be on the tax rate recon is dealt with in the final column. Now, you would recall from the first part of this video, in being assessed in this particular task, candidates had to identify the elements that were incorrect, partially correct, or where further clarification was provided, and then also the impact on the tax rate recon. It was not necessary in answering this particular task that candidates had to deal with the elements that were correct. And so therefore, in assessing competence in this particular task, we're then going to focus on the elements that were incorrect, partially correct, or required further clarification, and then what the candidates' responses were on the impact on the tax rate recon. So let's deal with this on a line-by-line basis. The candidate starts dealing with the loss before tax and notes that they agree with Julio. So therefore, there's no impact. Then, on the ticket revenue, the candidate notes that, well, there's probably some further clarification that is required. The candidate then notes that because these passenger service charges are collected for access, they would not be included in OTA's gross income, and then goes on to further expand on this particular principle, applying the principles from the Pyatt case dealing with gross income, and then if amounts are kept in a separate account. Then, on other revenue, which relates to food and beverages, that is correct, and so therefore the candidate doesn't provide any answer. On the disposal of equipment, which is also dealt with in the other revenue, the candidate notes here that they disagree and that there are incorrect elements. The candidate notes the incorrect elements as being as follows. Firstly, the accounting profit would need to be reversed. Secondly, the candidate then identifies, well, that this is the disposal of a depreciable asset, and therefore a recoupment would have to be calculated in terms of Section 84A. The candidate notes how this calculation should be done, being the difference between the lower of the selling price and the cost less the tax value. The candidate then thirdly goes on to identify that because there was a sale or disposal of an asset, CGT would have to be accounted for. The CGT would be based on the proceeds as defined, less the base cost as defined. Finally, then, the candidate correctly identifies that the taxable or the capital gain would be included into taxable income at 80% of the capital gain. That 80% inclusion has an impact then on the tax rate recon, and the candidate identifies that 20%, which is not taxable for CGT purposes, would be a reconciling item on our tax rate recon. Then, on the other revenue, the candidate identifies, well, the consideration needs to be given to the recoupment in that particular case. On the fuel cost, the candidate picks up that, in their opinion, this is partially correct or incorrect, and notes that fuel costs have been correctly deductible, but then goes on to say that forward agreements would have an impact on the tax calculation. Now, in the information of the day, candidates were provided with the fact that there was a forward agreement to purchase fuel. And a forward agreement is merely just agreements to purchase fuel in the future. A forward agreement is not an exchange item, and so therefore there would have been no Section 24I impact on the forward agreement. There's a distinction between a forward agreement and a forward exchange contract in this regard. Let's continue. On the employee costs relating to the bonus, the candidate here picks up the error. The bonus movement has been deductible, but correctly identifies that the bonus would only be allowed to be deductible if it has been actually incurred, and in being actually incurred would require that there would be an unconditional liability to make that particular payment, and recognizes that there is no unconditional liability at the end of the year, because the condition requires the employee to be in the employ 3 months after the end of the 2022 year end. In addition, a candidate for this particular part could have also dealt with the principles from Section 7 Cap B, but this candidate has correctly identified that there has been an error here. On the maintenance costs, the candidate deals with the maintenance costs correctly and picks up the errors that Julio has made using the information on the day as well as the pre-release information. The candidate identifies that there are various components to maintenance. There are minor maintenance expenses. Minor maintenance expenses, would be deductible, though the candidate incorrectly identifies that it is deductible under Section 11A instead of being Section 11D. On the maintenance costs, the candidate continues that where there's been a replacement of broken parts, these could be treated in one of two ways. If it is not a significant part, well, then it would be a deduction as a repair, which is correct, but Julio has not gone through this particular process. Alternatively, if it is a replacement of a significant part, this would be capital in nature and would not be allowed as a capital allowance because On Time Airlines does not own this particular aircraft. The candidate then, also in dealing with the repairs and maintenance, correctly identifies that if the repair is considered a replacement of a significant part and it is capital in nature and there is depreciation from an accounting point of view, that would probably be a reconciling item for tax because it is not deductible for tax purposes. On the commission, the candidate correctly identifies that they need to understand what this commission relates to so that they can confirm its deductibility. Next, on the unrealized losses on the APC, the candidate picks up that forward exchange contracts are exchange items in terms of Section 24I, and so therefore the gains or losses on a forward exchange contract are taxable. So gain or losses would be deductible or included into taxable income in terms of Section 24I. And so therefore Julio's treatment of adding the amount back would be incorrect. However, this candidate now goes on to deal with the exceptions in terms of Section 24I. The candidate identifies that, however, the add back would be correct, if the forward exchange contract, was an affected contract, or if the forward exchange contract related, to assets that had not yet been brought into use ultimately at the end of the year of assessment. So that's the principles from Section 24I7. So this candidate has displayed depth and breadth in their responses on a line-by-line basis. Let's continue. As it relates to the other operating costs, the candidate identifies, well, that this insurance payment is a prepaid expense, identifies that the portion from October 2022 to December 2022, which is the 141,750 Rand, would be deductible, but then applies the limitation of Section 23H and then identifies that the prepaid expense portion cannot be deductible in this case. We continue. As it relates to the office cleaning costs, candidate identifies that amounts that were incurred in the 2021 year of assessment can only be deducted in the year of assessment when it was actually incurred and cannot be carried forward or backwards to subsequent years. On the wear and tear of other assets, which we're told was deductible in terms of Section 11E, the candidate asked, I would just like to double check the calculations of these regarding the costs and the write-off periods used. So wanting then to match with what Julio has done to binding general ruling 7 in this case. On the interest expense liability, the candidate disagrees with Julio's treatment of just deducting that and saying that for tax purposes, the actual cash lease payments are deductible under Section 11A in this regard. On the annual learnership allowances, the candidate correctly identifies that, well, questions needs to be asked as to whether the learnership deduction, which Julio has claimed, would meet the requirements of Section 12H. So ask the question on the NQF level, ask when they've commenced and what the length of the agreement would be. Also then, from a tax rate recon point of view, the candidate identifies that the Section 12H allowance is a deduction for tax but not for accounting, and so therefore would be a tax rate recon, would have a tax rate recon impact. On the prior year assessed losses, again picks up the area which Julio made and identifies that the 80% limitation is only applicable for the periods after the 31st of March 2023, and therefore, because we're dealing with the 2022 year of assessment, the full assessed losses would be deductible. Also, in this case, as it relates to the assessed loss, the candidate correctly identifies that that particular assessed loss would probably have had an impact on our tax rate recon, and ask the question that they would need to understand the breakdown of taxable temporary differences available to us in 2021, and then continues to ask the question then to what extent the assessed loss in 2021 was in actual fact recognized as a deferred tax asset. Because if the full amount was not recognized as a deferred tax asset, well, then there would be a reconciling item in the current year. Finally then, penultimately, the candidate identifies that the incorrect tax rate was used at 27%, which should have been 28%, and then identifies the impact or highlights the impact on the tax rate recon, that the change from 28% to 27% would be have an impact on the tax rate recon. Finally, the candidate then identifies stuff which Julio had not included and asked the question as to whether Julio had included the interest income into his taxable income calculation, and identifies that interest income would be considered gross income. There would be no exemption. As can be seen, this candidate has therefore been assessed as competent. The candidate has provided depth and breadth in their responses and has dealt with a sufficient number of issues and highlighted errors which Julio has made.
Let's take a look at how this candidate dealt with task F. The first line item on ticket revenue, they correctly indicates that AXA passenger service charges should not be taxed in on-time's books, as this amount was not received for own benefit and on behalf of on-time. On the other revenue, they've simply indicated that you need to reverse the accounting treatment, but they haven't gone on to explain the correct tax treatment. for this profit on the disposal of furniture and equipment, and we wanted to see that part because the task had said if the treatment is incorrect or partially correct, indicate the correct tax treatment. The fuel cost treatment was actually correct, but there was mention of forward agreements. Although there was insufficient information to adequately deal with the forward agreements, we didn't know when it was entered into, what it was for. The candidate also simply says should be taken into account for tax, which doesn't really illustrate what are the tax principles that you would apply in dealing with the forward agreement. The employee cost included a provision for bonuses, and essentially for tax purposes, this is not deductible. So you could go about indicating that by saying you need to deduct the prior year provision balance and then add this year's provision balance, and that would essentially then reverse the adjustment that Julio had made. This candidate talks about the allowance granted in the previous year should be reversed in the current year, and the adjustment of the provision in the current year should be added to the loss before tax. Now, if you take these two together, it doesn't actually get you to the right tax treatment. It doesn't reverse the provision adjustment. Furthermore, the candidate didn't actually use any other tax principles to argue that provisions are not deductible. On the maintenance cost, there was a lot of information given around this in the case study. The candidate simply says adding back the 125 million is incorrect, no adjustment relating to routine maintenance and day-to-day servicing. This is accounted in the same way in terms of accounting and tax. So again, we're not seeing the tax principles that will have to be applied to justify that these amounts are deductible or not deductible. And then in dealing with the replacement parts and consumables, they just refer to Section 23 does not prohibit these deductions. But you're actually dealing with parts here that could be considered to be capital in nature, could be considered to be improving the asset. So we wanted to see a bit more in terms of how could you possibly deal with those items. For example, your consumables could be part of trading stock and deductible in terms of Section 22. On the unrealized loss on foreign exchange contracts, the principle indicated here is actually incorrect. Section 24 Cap I simply says gains would be included in income and losses are deductible in your taxable income calculation. No mention of at the earliest of incurral or payment. So this is incorrect. The other operating costs included a prepayment of insurance premiums, and the candidate simply did not deal with the prepayment in terms of Section 23 Cap H. They say the whole amount is deductible, which is incorrect. For the office cleaning costs, they correctly state that we cannot claim expenses for 2021 in the 2022 tax return. But then they want to say this will result in cut-off issues. So that's more of an accounting problem. What we wanted to see here was the application of the tax principles, possibly saying in terms of Section 11A, expenses are deducted in the year of assessment in which they were incurred. On the wear and tear, the candidate mentions that the right of use should be accounted for in terms of Section 12 Cap C. There's no capital allowances available for the right of use since the on-time does not own the asset itself. The candidate correctly dealt with the prior year assessed loss limitation, which is only effective for 2023 tax years, as well as the tax rate reduction. And then in terms of the tax rate recon items, the one that they correctly identified was the annual learnership allowance. So if we look at the candidates' answers in total, we can see that there's few of the issues that they correctly addressed. In most cases, they failed to actually illustrate the tax principle that would lead to the correct treatment of that line item. In some cases, they leaned more towards the accounting principles. So aside from the ticket revenue, the assessed loss, and the tax rate recon item of annual learnership, as well as the tax rate reduction, there really isn't much else that they correctly dealt with. And this candidate would therefore be considered to have limited competence.